much.
Today there will be little more number on YouTube.
Sorry,
Today,
sir.
the number will be a little more on YouTube. I have shared with one set of school teachers on personal
okay, fine.
finance, so they may join.
Okay, all right. Yes. So far, the number was almost 160, both Google Meet and YouTube. There are 280 some registered in the group, WhatsApp group.
Kasan, have you sent a mail to Deepak Rao, sir? Kasan,
Yes,
can
sir.
you send?
Should I do it?
No, you have sent.
Send him.
Sir,
Yes, already sent, sir. No, there. Sir, Deepak sir has been added. Already added. Yesterday only I've done it. Just checked.
Okay. Just check whether Deepak sir, are you there? Simplest or Deepak?
No, I'm not finding him anywhere. It's not there. Yet to join, I guess.
So we'll join now, Kasan. He did not get the mail, it seems. So
Okay, fine, sir. Yeah.
I have shared the link.
Okay. He's in.
Good evening, Manoj. Sir, can you hear me?
Yes, sir.
Okay. Hello. Good evening, Manoj, sir.
Good evening, sir.
Manoj, sir, you are.
I hope I'm audible.
Yeah, you are audible, Manoj,
Yes,
sir.
yes. So we'll wait for 2 minutes, sir. After
No
that,
problem.
we'll start.
Okay,
Because
sure.
normally
I
Google
just need
Meet
to
is...
share my PPT presentation.
Yeah, you can share, sir. You can share.
Rodriguez, may I know your full name, please? Kazim.
Kasin Rodriguez.
Okay,
Yes,
Kazim.
Kasin.
Okay.
Yeah, CASS.
Read it
Ian.
properly.
You can anytime cash in.
Okay.
It's also on YouTube Live, sir. We may have a good number. Normally it is full,
Okay.
100. Then most of them join in our YouTube.
Okay.
So you can share your presentation, sir.
Yeah, 1 second.
Do you need some help, sir?
Yeah, because it is telling me
Ah.
Google Chrome might not have screen recording permission on your computer. Go to system preferences for
No,
more
no,
help.
that is not required, sir. Sir, what you do is,
Okay.
on the bottom, there is an arrow mark pointing upwards.
Yeah, I clicked that only.
Yeah, click that. Then click entire screen.
Okay.
Once that is done, sir, then you can see all those boxes there in front, sir.
No, it is the same thing. Google Chrome might not have screen recording permission on your computer. It's giving me the same message.
You can't see those boxes, sir?
No, I cannot.
Really?
Because I'm joining from what is it, Apple system.
Oh, okay.
Is that a problem?
So, can you do one thing, sir? If you can share your email, your presentation, I will open it for you.
I'll do it right away.
Okay.
Please message me. Let me know your email ID.
I will do that, sir, right now.
Okay.
Done, sir.
Okay.
Is it done, sir?
Yeah, sent.
Okay, just 1 second.
Yeah, sent.
It has not yet come.
It was sent from my side.
Yes, now it has come. Yeah, just 1 second, sir.
Yeah. I can ask questions. There will be responses from the faculty.
Yeah, I think you can do it, sir. Absolutely no problem. I'm sharing it now.
Okay.
Kasin, I think you can start.
Yes, sir. Tracy, are you there?
Yes, sir.
Please begin.
Sir, whether my voice is audible?
You're audible, Tracy. Go ahead.
Yeah, you are audible.
Good evening, everyone. Dear delegates, today is the fifth day of the FTP organized by Milagres College, Hampankatta, Padua College of Commerce and Management, Nanturu, and Government First Grade College, Kavoor, in association with IQAC, organizing contemporary issues in taxation, investment, banking, and analytics. And today's topic will be Personal Financial Planning by Mr. Deepak K. Rao. So I now request Mr. Dandraj to welcome everyone.
Thank you.
Thank you, ma'am. Very good evening to everyone. It gives me an immense pleasure to welcome all of you to today's program. First and foremost, I would like to welcome and introduce today's resource person, Mr. Deepak K. Rao. He is the founder and director of Simplus Financial Consultancy Private Limited, Bangalore, which is into personal investment services, mainly for individual investors from all walks of life across country and outside the country, by having offices at Mangalore and Bangalore, and training on personal finance for common investors, corporate employees, retired persons, professionals, students, and others from all walks of life. He is having about 20 years of experience in capital markets since 2001 as an investment professional. He trained a lot of participants through workshops in various corporates, management institutes, and public forums, banks, and NGO. His professional achievements are: he is an AMFI registered mutual fund distributor since 2003. He is the founder and director of Simplus since the year 2011. He is the faculty for Certificate in Personal Investment Management at St. Aloysius Evening College, Mangalore. And he was the investment consultant at Skies and Ray Equities India Limited, Mumbai, in the year 2004. And he was the investment consultant at LKP Shares and Securities Limited, Mumbai, in the year 2005. He also contributed to the field of research by conducting researches at postgraduate level at Colacco and Arana, Bangalore. His works are an equity investment model for the common investors, worst case scenario on effectiveness of equity investment model, and an investigation into the effectiveness of systematic investment planning mutual funds. I heartily welcome you to the program, sir.
Thank you, Dandraj, sir.
Yeah, sir. And I warm welcome to Reverend Father Michael Santumaya, Principal, Milagres College, Mangalore, and Dr. Shivarama P, Principal, GFGC, Kavoor, and Reverend Father Arun Wilson Lobo, Principal, Padua College of Commerce and Management. And also a special welcome to Professor Manoj Lewis and all the participants of today's program. Welcome one and all.
Welcome to you too, sir. Now I request it's time to listen today's guest speaker, Mr. Deepak. Over to you, sir.
Sir, I'll share the presentation.
Yeah, sure. Yeah, thank you, Manoj sir. So, good evening, all the participants, principals, and dignitaries, especially Manoj Lewis sir for inviting me for this online session. It's always nice to deal with the money. I've seen people how they are scared all their life for money. I was attending one of the very high level session on psychology of money. I have seen in my life two, especially people live with the two extreme ends. I have seen people who has money but they are not able to spend it. They are scared of spending the money. That is on the one side. On the other side, I have seen people spend it lavishly. They spend. So I got very interesting insight in that session. Why people are scared to spend money, because money is a kind of safety for them. So anything in our life which is safety, which takes care of us, we'll not spend it. So it is like oxygen. The oxygen level goes down, then we find it difficult to breathe and difficult to live in our panic. So that's the reason we don't spend that money. Because a lot of them, it is security. Money is security. But on the other side, money is, for very few people, money is what is that? Freedom. So when money is a freedom, I want to buy that freedom by spending the money. So this is a very, very interesting thought process when it comes to psychology of money. So I may share something else maybe in the forthcoming sessions when an opportunity given. So coming to a very interesting and very important topic, personal financial planning. Every individual, as long as you deal with the money in your life, you must understand the basics of money management. So today I'm not going deep into a personal financial planning. I will deal with the basics of money management. Then it is very easy to follow or implement the personal financial planning in all of your life. Okay, so this is so whatever I learned, it is from my mentor, Mr. Gerard Culasso from Mangalore. Since 1985, he's an investment consultant. So I'm a student of Gerard and investment since 2001, being my MBA days. So he given me this very interesting, very interesting thought process. So what's happening in today's personal financial services industry? This is exactly what's happening, and I have been witnessing this for the last 2 decades in my career of investment advisor. So today the world's personal services industry suffers from basically 4 main parameters. They are frightening complexity. What does that mean? So any simple things. Today, if you go to anybody bank or they try to sell you financial products, or the insurance company or the mutual fund, whoever try to sell you any product, they are not able to in a position to explain it in a simple terms to the common investor. That's why common investor find it very difficult to understand. So they make it very complex, as if the money investment belongs to some PhD level people. Nothing of that sort. Money has to be brought down to a common investor's level, because everybody deals with the money. That's the first thing. Second thing is dangerous lack of ethics. People, the so-called advisors sell or agents sell financial products which gives them maximum commission, which is completely wrong from point of view of a buyer. So there is absolutely no ethics. So the advisors or agents keep thinking what is good for them, which product gives them maximum commission, they will sell that, which is exactly a wrong product to be bought by the investor. High pressure selling, which is nothing but a target. So all the companies give target to their employees. They must achieve their target by selling the products, whether it is suitable to the investors or not. And last is grave disregard for investors' interest. So this sentence tells you very clearly the kind of interest, seriousness, or ethics in today's personal financial services industry has towards the common investors or common people of the country. So I want to give a disclaimers, because this is what we tell our investors very clearly. We cannot make you rich overnight, because we do not know how to do it. Simply, if I know how to make money overnight, I am not supposed to be in this profession, because I myself will make money for myself. I will never come and share with you. It's a very normal human tendency. And I'm also not here to do any kind of marketing, or promote any kind of investment product. This is a pure educating, enlightening, and empowering session, so that you can find some value in our session, so which you can use it in your personal investment life and become a successful investor in life. We also do not collect any of your database, like your mobile number, email ID. No, we never do that. If somebody does that, so they started chasing you, calling you even midnight and calling you, they try to sell you some insurance product. So I'm here to just share my thought process. Yeah, next slide, please. Okay, so this is very clear. Information and knowledge, which is abundantly available in colleges, textbooks, internet, everything is available. Pure information knowledge. Actually, today information knowledge is a overflow. You need to make an extra effort to understand what exactly is required by you. Because if you go to Google and hit mutual fund, at least there will be 10,000 pages opening in front of you. So you have to make an effort to understand what exactly you need to read, which is of use to you. So in my entire session presentation, I'm going to deal with the only insights and wisdom, pure insights and wisdom, not just knowledge and information, insights and wisdom, which is really helpful to you, which I'm sure is going to do a value addition to you. Yeah, next slide, please. This is the first sentence I'm going to open my presentation. Warren Buffett, I need not tell you, legendary investor of the century. He said, investing is simple, but not easy. Because in my career for the last 2 decades, I have seen common investors or common people suffering with their money and investments. They do not know how to handle their investment. They find it difficult to manage their money. So that's why today majority of the people are, especially with the guaranteed and contractual investments, which I'm going to explain after a bit while. Because the total bank FD size in India today itself is around 140 lakh crores. Just think the rate of return we are going to earn out of it as of now, it is around 7% per annum. I'm talking about a nationalized bank, not a senior citizen below 60. So 7% per annum, 140 lakh crores. So this data tells you very clearly that we Indians do not want to take risk to our capital. We are fine earning less return, but we do not want to take risk to our capital. Okay, so investing is simple but not easy. But also I have seen a few people with a half-baked knowledge enter into so many investment products and burn their hands, which is very dangerous. Okay, so now the question is that why? Why investing is simple but not easy? It is not easy because we as humans cannot control our own raw, wild, crazy human financial behavior. And then we enter into so many investment products where we cannot control it and things will go against us. Next slide, please. So what is the quality investment philosophy? We follow few precautions at Simplest is that our mantra is that an educated investor is a successful investor. We always focus on educating, enlightening, empowering investors. So we also tell our investors or people, invest your time before investing your money. This is something very interesting in human psychology. When it comes to earning money, we work very hard to earn money. We sacrifice our lunch, breakfast, our family. We go to different places, live there, work hard and earn money. But when it comes to saving and investing that money, I have seen people are not at all serious. They are completely careless and invest in wrong investment products and they lose that hard-earned money. Then what is the very point in earning that money if you are not serious about saving and investing that money? So one more very important thing is that it is always better to prepare and prevent rather than repair and repent. This is what we tell people repeatedly. Ask all the questions, do all kind of research before entering into any investment product, not after that. Because once you invest, then you have to get out only by paying the cost. You suffer a cost. And also what is important at Simplest is safety first, returns later. We never compromise with the safety. We have seen people becoming victims of their own financial behavior. Like we have seen so many people keeping money in a cheat funds, cooperative banks for higher returns, and then they get burnt their hands. They lose their money, which is very, very dangerous. So all these points you need to keep in your mind before investing your hard-earned money. Next slide, please. So this is the 2-3 concept you have to keep it. 2 concepts you have to keep it very, very important, and always you should remember it before taking any investment decisions. First, we humans suffer more from our imagination than from reality. We think something is going to happen in future, so invest that money into that particular investment product. But what will happen in future? Something completely different would take place. then we lose our money. That takes us to the second very important concept. There are two set of things in this world. Only a handful things which are under our control, a zillion things which are not under our control. So what we need to do? We need to focus only on things which are under our control and completely ignore the things which are not under our control. This is, if you can understand these 2 points, take it from me, you will never lose money. You will never make a wrong investment. So these 2 points are very, very important. You have to keep it in your mind. Things which are under our control, things which are not under our control. Don't focus on things which are not under your control. Focus on things which are under your control, like what are your financial goals? What is the investment time horizon of your financial goals? What is your risk profile? What is your applicable asset exposure? All these things are very important to become a successful investor in life. Next slide, please, Manoj sir. One more very important concept again. Saving. Saving is the mother of investment. We as an Indians are excellent savers in the world. The entire country save about 35% of our household income, which is an excellent saving ratio. We as a country are excellent savers. But the problem is that when it comes to investing, we are not great investors. That is the main problem. So what is the very basic definition of investment is, we have income, we have expenses, so we must save, and that saving should be invested towards our family's various financial goals. The first one is a very normal formula which everybody can follow. But if you can shift yourself to the second formula, that itself is a very powerful formula that makes you a successful investor. Out of our income, we must save first. Save and invest, and the balance we can spend. I'm sure some of you may be following this, and especially if you look at your parents and grandparents, I'm sure they must be followed the second formula. They saved first, however difficult, out of their income, because they believed in tomorrow, they believed in future. Today, the youngsters are started living, very dangerously, and mall, credit cards, plastic money, so many things are there to make you a spendthrift. So please look these 2 formulas very carefully. Coming to here, one very important concept here I would like to explain is that what should be the minimum savings we must do as a income earner. So at least what we recommend is that at least 25% of your net income should be saved. In other words, if you are earning, let's say, 1 lakh rupees per month in your hand, today on an average 40 to 50% will be your cost of living. And if you have loans, your EMIs can be around 25% of your income, which is around 25,000 rupees. You must save 25,000 rupees, which is 25% of 1 lakh rupees, to be saved and must be invested towards future financial goals of the family. So, most important. Yes. This is the one thing I think, being a faculty member, all of you know this. What is inflation? We have been learning this concept or this word since our PUC days, if you are a commerce student, and then we teach. But unfortunately, this remains only in the books. Here, I have not seen people really, using it in their real life. What is inflation in the simple words? The real value of money coming down year-on-year basis on the one side. On the other side, the cost of living going up and up. This is a simple effect or understanding of inflation. The real value of money on the one side going down and down, and our cost of living going up and up. You must have realized this whenever you go to marketing or shopping, buy vegetables, whatever it may be. We always complaining the cost is keep on going up and up. So how do you manage? All these things will come. The simple reason is inflation, which is part of the economy. So the current average inflation in the country is about 6%. The consumer price index, I'm talking about CPI, not the wholesale price index. The CPI is about 6.01. So I just kept it at 6. So what does this mean? Whatever the goods and services costing 100 rupees this year would cost you 106 rupees next year, because the inflation is 6%. That means our cost of living is becoming 6% costly year on year basis, which is nothing but we are paying an indirect tax 6%. Okay, we like it or not, because this is not under our control. This is part of the economy. Yeah, next slide. So now let us compare that inflation. How does it affect the common investor's life? I told you bank FD is the darling of Indian investors. 140 lakh crores total bank FD size. So what happens is that we keep 100 rupees in a bank FD at 7% per annum. Currently, the bank FD interest has slightly gone up due to inflation. So currently we are running about 7%. So what happens? 100 rupees we keep at 1 year bank FD at 7% per annum. After 1 year, if you go to bank, the 100 rupees would have become 107 rupees. You take out that money, 107 rupees, withdraw that money from the bank and go to market to buy your goods and services to live your life. The inflation being 6, whatever the goods and same quantity and same quality of goods and services costing 100 rupees last year, this year it would have become 106 rupees. So you have 107 rupees in your pocket. So you buy goods worth 106 rupees. How much is left in your pocket? Just 1 rupee. Then you will be wondering, I earned 7 rupees interest from my bank FD. But after buying my goods and services, when you come back to home and when you see in your pocket, you can see only 1 rupees. Whereas the 6 rupees has gone? 6 rupees has eaten by the inflation. So what happened to your purchasing power? You had 7 rupees, 6 rupees eaten by the inflation, you have got only 1 rupees. So with 1 rupee having in your pocket, how do you increase your standard of life? Because you do not have purchasing power to increase your standard of life. So inflation is the one most dangerous and one very important parameter to be taken into consideration while taking investment decisions. Next, please. Once you understand a very important concept called inflation, we must understand the next step, which is real rate of return. Very simple formula. Real rate of return is equal to gross rate of return minus taxation minus inflation. So taking the same example of bank FD interest rate of 7%, I'm sure all of you know that you must have kept money in a bank FD as an income earner, and also you know that it is fully taxable. The interest will be accrued and it will be added to your taxable income, and you have to pay tax at the rate of your income tax slab. So taxation, either you are at 20% or 30%. So 7%, 20% means 1.4% goes to the government of India in the form of tax. If you are in a 30% tax bracket, 2.1% goes to the government of India in the form of income tax. So post-tax from your bank FD interest rate is either 5.6, that is 7 minus 1.4% is equal to 5.6, or 7 minus 2.1 is equal to 4.9. So from this you have to deduct inflation further. So if you are in a 20% tax bracket, 5.6 minus 6% inflation, you are minus 0.4%, or 4.9 minus 6%, you are minus 1.1%. In both the places, your purchasing power is negative. That means it is very clear that after paying towards taxation and inflation, your real rate of return in the hand is your minus. That means you are growing negatively year on year basis, which is very dangerous, because it will further compound. The minus will compound further going forward. So you do not have absolutely any purchasing power in your hand, because your real rate of return is negative. So the lesson to be learned from this real rate of return is that always see that your long-term investments return is always positive real rate of return. It must generate positive real rate of return after beating inflation and taxation. Otherwise, you will be never able to increase your standard of life because the purchasing power is not increasing. Yeah, this is I already taken care. Next slide, please. Okay. Now, this is the one risk, I have seen you all being the faculty members, you deal with this at a textbook level, day in and out. Risk, very easy. Risk, your systematic risk, unsystematic risk, there are so many things. So, first of all, we need to understand what is risk. Because I told you that very clearly, 140 lakh crores is the total bank FD in India. So something is telling them in their mind, do not invest in equity market or so many else and all, because the one question why you are not investing so many other places, the people say the 4-letter word called risk. What is this risk? Risk is nothing but a probability or a chance of losing my capital. That is risk. I put money, I invest money, and something goes wrong. Either the market goes down or the company itself is disappeared. There are so many things can happen. So that is nothing but a probability or a chance of losing my money is risk. The second is the chance of earning less than bank FD return itself is also a risk. So first is risk to capital and the second one is risk to return. So these two are called risk. Now where is the risk? Now this is the one very interesting and very challenging thing to understand. If you can understand this, then you'll be laughing at risk. Now the question is that where is risk? I have seen people talking about stock market is risky. People say stock market is risk or something else is risk. No, I do not agree with that point. I'll give a very simple example. Imagine there are two friends, A and B. A bought a new bike and B took that bike for a jolly ride. And he met with an accident. B, while riding the bike, he met with an accident. And now he goes to police station and give a complaint against A that because of A's bike, I met with an accident. So Mr. A has to give me 10 lakh rupees. So this is a very interesting thing. So if I am a judge, so I'll ask a simple question: who was riding the bike when it met with an accident? So B, A was not at all in the picture. He was somewhere because B alone took the bike. The next thing what I would ask is that I would ask some mechanic to go and check the bike because I just want to know what is the speedometer was running at when the bike met with an accident. So the mechanic tell me it was showing 150 km per hour. Then I ask a simple question to Mr. B. Now, who asked you to ride the bike at 150 km per hour? Because you are going at a very high speed and you lost control and you met with an accident. Simple. The case is solved. You are getting my point. So, where is the risk? The risk is not in the bike. Please understand. A was riding the same bike at 50-60 km per hour and he was commuting from his office to home without any problem. But it is the Mr. B who was riding the same bike at 150 km per hour and met with an accident. So investments are also like that. So we humans are very intelligently tell stock market is risky, equity is risky, or something else is risky. No. It is the rider who is where the risk is within you. If you do speculation or a gambling in the stock market or any other places, you by taking a very high risk, then risk is within you. The risk is not in that particular commodity or a product. So the answer for where is the risk is within you, not with the product, investment product. Now, what are the different kinds of risk and how to minimize the risk? Okay, minimize the risk. We have to. In the next slide, I'm going to deal with the different kinds of risk and how to minimize the risk. Also, I'm going to tell you because we need to do a lot of follow simple but quality investment strategies. Next slide, please. Okay. Now, at a very broad level, when you are talking about risk in investments, I'm talking about, they can be divided into two major segments. Risk that can be managed, risk that cannot be managed. Just 15 minutes back, I was talking about something else. Things which are under our control, things which are not under our control. This is very much related to that. Things which are not under our control, where we cannot manage the risk. Now, can anybody tell me the outcome of the election of May 2020? No, we do not know. We can bet and we can come out with our own opinion, and we can bet. Human beings are by born. We are born speculators, so it is in our blood, the speculation. So we humans try to make speculation money wherever possible. So you need to understand very clearly that risk that can be managed if you think you can manage the risk, then we must examine that risk so that we can convert that risk into rewards. If you think there are in so many places risks that cannot be managed because things are absolutely not under our control. So wherever risks that cannot be managed, so we just need to avoid that risk. But unfortunately, we humans are doing exactly reverse. Wherever we can manage the risk, we will never give importance and we will never look into it, how we can convert that risk into rewards or returns. Things where we cannot manage, we'll get into that. There are a lot of people started betting in IPL. Unless you are a match fixer, I agree. But as long as we are not a match fixers, we do not know the outcome of the IPL and we try to make money because we are just trying our luck. If you invest in a place where you cannot manage the risk, which is nothing but you are trying your luck. Luck is not 50-50 chance. Either you are lucky or you are unlucky. Simple. Yes, next slide, please. So these are all the few simple textbook risk, what you know, the different kinds of risk. Credit risk, where there is a chance of losing our capital, which is called credit risk. Liquidity risk. When required, we are not able to sell our investments and convert that into cash. So that is a liquidity risk. Liquidity risk, you will find it in real estate especially. Because when you need money, you will find it very difficult to sell. There is no buyer. The money involved is big. So you may require 6 months, 1 year or more time to get a right price and a right buyer to liquidate from your real estate investment. Let's say you have got a money in a bank FD or something, it's very liquid, or a gold and all. You can immediately go to a jewelry and you can sell it, or you can withdraw money from your bank. Volatility risk. If you are invest in a performance-based investment like real estate, equity, commodities, all this keeps going up and down. You are supposed to take more risk when compared to bank FD. That's why you may earn more compared to bank FD. Inflation risk. This is I already explained you. Inflation risk is very, very important. So this is a challenge when it comes to guaranteed and contractual investments, which I'm going to deal with it in a little while. Next slide, please. So all the available investment products in the country are divided basically into three main segments. First one is guaranteed investment. Second one is contractual investment. And the third one is performance-based investment. What is guaranteed investment? In guaranteed investment, repayment of principal and interest is guaranteed by the central government or the government of India. So it could be your senior citizen savings scheme, employee provident fund, public provident fund, all post office schemes. All these things where the repayment of principal and interest is guaranteed by the government of India. This is guaranteed investment. The second main category is contractual investment, where the repayment of principal and interest is a contract between the lender and the borrower. Bank FD is one very good example. If you keep money in a bank FD, which means you have lent money to the bank, and bank being institute is a borrower. So, but it is not guaranteed by the central government. It is guaranteed only to the extent of 5 lakh rupees. If let's say you have kept 10 lakh rupees bank FD and the bank goes into liquidation, you are guaranteed for 5 lakh rupees, because that is called Depository Credit Guarantee Corporation of India. So which will guarantee 5 lakh rupees per person, per branch, per account. Okay, so if you look at Indian investors, majority of their investments, they invest either into guaranteed investments or into contractual investments. In both the places, your return is either equal to the inflation or less than the inflation in the country. So that's why we are not able to grow rich, because we do not have sufficient purchasing power. So the third category, next slide please. The third category is performance-based investments. Here, neither the principal nor the interest is guaranteed by anybody. It is depend on the performance of the market, or how effective is your investment strategy, or how efficient is your investment advisor. Either any one of the reason, or put together all the reasons. So the example of performance-based investment are real estate, equity, commodity, gold. This is only the investment class, I'm telling you. Yeah, next slide, please. But performance-based investment, where you can beat the inflation and earn real rate of return. So now the next question is that why do we invest money? Why do we invest money? What are all objectives of investment? There are only 4 main objectives of investment. First one is we want to increase value of our investment, which is nothing but we want to create wealth in the long term. That is our first objective. Second one is to earn tax efficient income, or earn a regular income from that investment, which will help you once you retire. Third is liquidity. We also want liquidity, ensure maximum possible liquidity. And last but not the least is we need to have a safety of that investment. So 4 important objectives: enhancing the wealth, earning regular income, tax efficient income, liquidity, and safety. These are the objectives. Next slide, please. So there are 6 golden rules of investing. You have to follow this very, very strictly if you want to become a responsible and successful investor in life. First is invest as early as possible. Don't worry about small or big amount. Invest regularly, invest for long term. The next 3 are very interesting. Next slide, please. This is very important. Keep your investment very simple. Do less activities and manage your stupidity. We need to do this. Otherwise, we have seen people, without have any control. They don't know where they are going, what is their investment objective, what is their time horizon. They absolutely do not know. They just do something, which is very dangerous. If you follow these 6 rules, invest early, regularly, for long term, keep it simple, do less, and manage your stupidity. If we can do this, we'll become a successful investors in our life. Next slide, please. This is very important. All activities we do must start with the plan. If we fail to plan, we plan to fail our investment. So be very careful. You have to plan. Next slide, please. What is plan? In short, what you need to do is that, see, all these are very much connected to the personal financial planning which I am talking about. So the plan I'm talking about is that what is the steps we need to take under the plan. You have to make a list of your family's financial goals. Financial goals could be your children's education, children's marriage, your own retirement planning. You want to buy a house, you want to buy a car, you want to go for a vacation. All these things are financial goals of the family. Second step is that you have to identify what is the time horizon of each financial goal. Is it short term, is it medium term, or long term? Short term, anything that is less than 1 year is short term, 1 year to 5 years is medium term, more than 5 years is long term. Especially children's education, marriage, your own retirement is long term goals. So less than 1 year could be you want to buy something, make a down payment, you want to buy a car, you want to go for a vacation. All these things are short term. Medium term could be something. Let's say you want to buy a car within the 3 years, you want to buy apartment after 3 years. They are all medium term. So once you made a list of the financial goals of your family, then define those financial goals with the exact time horizon. And also third important thing is that what is the approximate cost of that financial goal, which is very important. Because once we know the cost of the goal, then we can plan. Otherwise, you say, Deepak, I want to buy a car. I want to buy a car in the next 3 years. Okay, I'll say 5,000 rupees. So if you start investing 5,000 rupees or 10,000 rupees, at the end of the 3 years, 3,60,000 invested, it has become doubled, which is excellent return. But you are not happy because you want to buy a car worth 50 lakh rupees. So these all the parameters are important. Identifying the goal, time horizon, and what is the approximate cost. Next slide, please. Okay. In the next 2-3 slides, I'm going to make you very clearly this all the real data. The power of long-term investing. See, short-term and medium-term investing are not that challenging. But if you make a mistake in the long term, then you are going to lose heavily. So just look at the S&P BSE Sensex, which started with 100 points as on 1st April 1979. So in the same month, we completed around as on yesterday, because today it's not a trading day because of the Ambedkar Jayanti. It's a holiday to the stock market. So as on yesterday, the Sensex ended with 60,431 points. That means 44 years completed. 79 to 2023, 44 completed, 44 years. So if you make a simple Excel calculation, what is the, by putting the two figures, 100 points in 1979 and 2023, 60,431 points, it will tell you what is the XIRR, that is internal rate of return. Average return for the last 44 years is about 15.67% per year, which is excellent. 15.67% per year for the last 44 years is out of this world, imagine, without any risk to capital. So in other words, if you had invested 10,000 rupees in Sensex 1979, and today its value is 60,43,100 rupees after 44 years, at the average rate of 15.67%. Tell me, where is the risk in equity if you are a long-term investor? Long-term means 5 years and above. So this is a real-time example of Sensex or a direct equity. Next slide, please. Look at a real-time example of a large cap fund, because I do not want to give an example of a mid cap and small cap or some other things. We stick to ourselves only to passive index funds or large cap fund. So this fund started in January 1997, completed 26 years as of now, 97 to 23. So if somebody had started investing 1,000 rupees per month in this large cap fund from day one, continuously invested 1,000 rupees and also not withdrawn anything in between. So what is the current market? What will be our total investment? 3,15,000. 315 months. 1,000 rupees into 12 months into 26 years. So we invested 3,15,000 rupees over a period of last 26 years. What is the market value as on 31st March 2023? 51,42,266 rupees. Look at the power of long-term investing in equity. This is in a mutual fund. So 1,000 rupees per month, any common man can invest. It's not a big deal. But this is, I'm showing you to the power of make you understand the power of small investment. You recollect what I said, my golden rules. Invest early, invest regularly, invest for long term. A 1,000 rupees SIP in a right mutual fund scheme, not in a wrong mutual fund scheme. That is very important. So we invested just 3,15,000 rupees over a period of 26 years. Every month 1,000 rupees. We are not invested 3,15,000 rupees at one shot as a lump sum investment. Every month we invested. So 1,000 rupees per month. And today, let's say now your children education or children marriage or our own retirement, a decent time horizon is about 20-25 years. And we invested 3,15,000. Today you will get a shock, which has become 51 lakh rupees. That means my mutual fund investment 1,000 rupees is growing at a rate of 17.55% average return per year for the last 26 years, which is excellent. Once again. Next slide, please. because people don't understand the power of long-term equity. So real estate. So people see this is the one of the myth in the minds of the people. Real estate is a great investment. No, if you look at the average compounding return of the real estate in India for last 30 years is about 18% per annum, which is almost equal to the equity. But imagine the kind of risk you have in real estate, which is very, very high. And real estate is certainly not for common investors. You need a big money to invest in real estate. You must have the knowledge, talent, and skill to identify the right property. The risk is very high in the real estate. The real estate investment time horizon is 10 years and above. And there are so many other things. Liquidity is a problem. So by taking all those risks, the average return I'm talking about, not the best return or not the worst return. The average return works out to be 18% compounding in the country for the last 30 years, the average return. So equity, real estate, yeah. Next, gold. People think gold is some great investment. In the long term, look at the data for the last 95 years. The price of 10 grams gold during 1925 was 18.75 rupees 10 grams. Today, as on today, the price of 10 grams gold is 62,770. 98 years. If you calculate XIRR, internal rate of return, for the 98 years in gold works out to be 8.63% per year average for the last 98 years. By investing in the gold, you have not lost money. At the same time, you have not made money because gold is always growing at the rate of inflation. Gold as a jewelry, I am not considering here. I am talking about gold as an investment. If somebody says, then this is the return for the last 98 years in the country. See, we need to have the data to talk. We need to have a data points. We have seen people simply talking, arguing and all without any data points. So this data will make you clearly what is the kind of return or growth in equity, real estate and gold, which are the only three investment avenues you must invest in the country to earn a positive real rate of return. Yeah. So now I compared that real rate of return with all the things. So real estate, I said 18% and 20% long-term capital gain you have to pay and minus 6% inflation. So after paying taxation and inflation, so what is your positive real rate of return is 8.4% per year compounding return, which is excellent. This is nothing but increase of your wealth. The one more avenue of investment for long term is that your own business. But how many people can start their own business? In India, it is about the figure says around 20% people can start their own business and they can earn a profit, good profit, decent, excellent profits. But 80% of the people are salary class, where you need to save money out of your income every month. You must invest.
I think sir has lost connection. Kasim?
Yes, sir, I think so.
Okay, let's rejoin.
Sir, unmute your mic.
Sorry, there was a disconnection. This is one of the disadvantage of technology, depending on the technology.
I will start present sharing.
Yeah, please. Yeah, that's a correct slide. So I was talking about direct equity, 15.67%, 44 years, last 44 years average return, minus taxation, minus inflation. So still we have got positive real rate of return of 8.1%. Coming to equity mutual fund portfolio, last 23 years return was 17.55%. Out of that, deduct capital gain taxation and inflation 6%. We are left with positive real rate of return of 9.8%. And gold return is 8.63% for the last 95 years. Deduct taxation and inflation, we are positive real rate of return is about 1%. So I never advise you to invest all your money into any one of the asset class. We need to diversify across asset class based on your if your investment goals are long term, based on your risk profile and asset allocation. Next slide, please. So this is what I already dealt with. Okay, so yeah, we can go to the next slide, Manas sir. Okay, so now all these slides we made an attempt to understand the basics of money management. Coming to personal financial planning in a very nutshell, there are 6 areas of personal financial planning which has to be covered by the individual. First and foremost important thing is that insurance is nothing but a risk cover. Under risk cover, we need to have a medical insurance for all the family members to take care of any health issues, medical expenses. So medical insurance is must for all the family members. Critical ill insurance, where as of now around 40 critical diseases are identified as a critical ill insurance. If a person takes a critical ill insurance and critical illness affected that person, and if he is and the money is given to that person to take care of the critical ill insurance, which is costly to medical expenses, which is a costly medical expenses. Third one is a personal accident policy, which takes care of complete and partial disability. So people do not understand this unless they get into the situation. But especially we recommend for professionals to take accident policy because if the person becomes a complete or partial disability, then he may lose the power of earning income. So in such kind of situations, this personal accident policy is of a great help. Life insurance policy is a major point I need to spend a minute or two, because here majority of the people completely do blunders. You must take life insurance only if you have people financially dependent on you. This is the first question you need to understand before taking life insurance, whether you need life insurance or not. Whether do you have any people financially dependent on you? Financially dependent on you. If the answer is yes, you must take life insurance. If the answer is no, you don't need life insurance. Now, next question is that how much life insurance you need to take. You must take life insurance to take care of your financial dependence, basic monthly cost of living. Example, if in the absence of the breadwinner of the family, if the family dependents require, say 25,000 rupees per month for a basic standard of life. So calculation is simple, 25,000 rupees into 12 months. How much they require per year? 3 lakh rupees. So the breadwinner of the family has to arrange this money in her absence. So if he takes a 50 lakh rupees life insurance, in the absence of the breadwinner of the family, the insurance company would pay 50 lakh rupees to the financial dependents, and that 50 lakh would be kept in the bank FD at 6% per annum. At 6% per annum, we are going to generate 3 lakh rupees per annum. Divided by 12 months, we are able to generate 25,000 rupees per month. This is a simple calculation. But if somebody wants to take care of the inflation, then what you need to do is that you need to double that money. 50 lakh rupees, you have to take it as 1 CR. To that 1 CR, you have to add your financial liabilities, if any, or you have to deduct financial assets, if any. Value of the financial assets. Okay. So, hope you understood the simple calculation. But when it comes to life insurance, I am telling you very clearly, the only one kind of policy worth buying from the point of view of a life insurance holder or a policy holder is pure term insurance. Never buy a money back endowment or a ULIP policy, which is completely wrong. We recommend only pure term life insurance, which is the suitable product, because that comes into picture only in the absence of the breadwinner of the family, which is the real meaning of life insurance. In rest of the places, only the agents makes money and the policy holders growing at the rate of 3.5 to 7% per year, which is equal to inflation or less than the inflation in the country. So, and also understand insurance is not an investment. That's the reason I told you very clearly, insurance is equal to risk cover. The focus is risk cover. It is not an investment, not even tax saving investment. Unfortunately, people sell and buy insurance product either as an investment or as a tax saving, which is completely wrong. Okay. And property insurance for one's apartment or house to take care of the risk of any natural calamities. Household insurance is the one which takes care of risk for theft and fire in the house, which you have got if you have any costly gadgets, electronic items at home, that will take care of. So with that, we completed insurance. Family emergency fund. What we recommend family emergency fund, at least 12 months of your basic cost of living, you should be able to touch at any point of time. If somebody's cost of living is 25,000 rupees per month, 25,000 rupees into 12 months, 3 lakh rupees should be kept ready, or it should be accumulated over a period of time. Otherwise, what will happen? People never keep family emergency fund. So in case of emergencies, either they go for personal loan, very costly, cash credit, overdraft, credit card loan, all these kind of loans which are very costly. So we always recommend families to maintain family emergency fund. So in case of emergencies, for the next 1 year, we need not worry about our income stream. We can live our life, and also we can pay all our bills without taking any loans and without selling our assets. The third point is retirement planning. Government will not take care of us. We cannot depend on our children. So we are responsible for our own retirement, comfortable retirement. So the right time to start retirement planning is right now. The day you start earning, you should start investing a very small amount towards your retirement corpus. Because one fine day we have to retire. We cannot continue working forever. Housing is a question. So there are a few people want to take a housing loan and then continue paying the EMI, which is fine if you have a steady income and steady cash flow. Because the moment you go for a housing loan, it becomes an obligation for the next 15-20 years. So we do not want to push people into obligation, because that creates stress in the minds of the humans. So if somebody is comfortable living in a rented house and ready to buy a house based on his or her financial condition, if you are strong financial condition, perfectly fine. Number 5 is repayment of your loans. So if you have got any dangerous loans like credit card loans, personal loan, cash credit, overdraft, we always recommend our investor, our clients to repay the dangerous loan first, then starting investing. So number 6 is general investment. General investment is nothing but investing towards your family's financial goals like children's education, children's marriage, vacation planning, vehicle purchase. All these things comes under general investment. But if you follow these 6 steps, then there will be no financial worries and financial shocks. I already shared the personal financial planning literature of my mentor with the Manoj Lewis sir. He must have sent it to all of you, forwarded. And also I shared one more very important document that the action you need to take on the personal financial planning one by one. So next slide, please. So this is very important. We have seen people planning like a government, but no action. No action is equal to no results. One dangerous human financial behavior is procrastination. We keep on postponing things. Never do that. Start investing. Action. Small investment. Don't worry, big or small. Start. Invest early. Invest regularly. Invest for long term. That is the beauty. That is the secret. Yeah, next slide, please. So this is the first 4 parameters are very important. If you are making any investment for that matter, you must understand what is your financial goal or an investment objective. Second, what is the time horizon of each of your investment objective? Short term, medium term, long term. Then third is what is your risk profile? Are you a conservative, moderately aggressive, or aggressive human financial behavior? And based on that, what is your applicable asset allocation? Is it 40% debt and 60% into wealth enhancing financial asset if you are conservative? If you are moderately aggressive risk profile, then it is 25% debt, 75% into wealth enhancing financial asset. If you are aggressive personality, then no debt, 100% into wealth enhancing financial asset. And when you are making lump sum investments, market levels of wealth enhancing financial assets are important. Wealth enhancing financial assets, I mean Indian equity, international equity, and gold. There is a concept called margin of safety is very important to decide lump sum investment or go for systematic transfer plan. Systematic investment plan, you can start at any day, provided if your time horizon is 5 years and above with a good portfolio. That is important. These are the 2 conditions. Next slide, please. Okay. We at Simplus never, I already told you we can't make you rich over a night. We don't know that formula. What we focus at Simplus, we only focus on minimizing risk, volatility, and cost. And what is the end result or a reward is nothing but the return. But what happens in the outside world, the people are focusing on maximum return. And what comes and kills them? Risk, volatility, cost, and kills them. So they focus completely on a wrong point. If you focus on minimizing cost, risk, and volatility, then return is your end result or a reward. If you focus on maximum return, risk and volatility will kill you. Next slide, please. So what is a few interesting things? This is the next slide is the last slide. We at Simplus never mix human intelligence and human emotions with our predefined investment strategies. People, when it comes to investing, people start worrying. They start using their intelligence, emotions. That will never allow you to invest. But we will never mix it. We define the financial investment strategies and we follow it strictly. That is the secret of our investment success. And what we focus, we want to make you debt-free. In the sense, try to live a debt-free life without any loans, without having any dangerous loans. And we at Simplus try to make our clients' money risk-free, because we have seen the kind of risk people are worrying, struggling, suffering. So we don't want your investment to be risk-free, so that you can live a life of stress-free. So this is the one-point agenda of Simplus: debt-free, risk-free, and stress-free. Next slide, please. Yes, with this I have come to an end of the session, which I try to keep it at a very simple level by explaining the basics of money management and personal financial planning. If you have got any question, I am happy to answer. Over to you, Manoj sir, or Kasin.
Sir, I have 2 questions.
Please.
One is, which is the best SIP can you name? SIPs. Second, where we can invest? Which avenue is the best to invest?
Okay, I will come back to the same. Good point. So I cannot give you answer right now. Because I want to know what is your investment objective. I want to know what is your investment time horizon. I want you to answer my risk profiling questionnaire so that I can understand what is your applicable asset allocation. Because these are all unique. See, your risk-taking capacity may be different than Manoj sir. So you may be having the same amount, same objective, but Manoj sir is comfortable driving 120 km per hour his car, but you may be only 50 km. So risk profile is different. This is, that is the biggest mistake people does is copy one's investment and other. It's a completely unique. So four parameters. What's your investment goal, time horizon, risk profile, and applicable asset allocation. If I know these four things, then I'll be able to answer.
Okay. Yes.
And then I will divide your money into debt, Indian equity, international equity, and gold.
Okay.
Yes, any other questions?
So there are some questions in the... Yes, you can go through, sir, in the chat box.
Okay. Thank you, madam. Tell me, Pati, thank you. Okay. Thank you, Ganesh sir. Please, as you mentioned in the market, there are many agents who will suggest us few schemes where they earn good amount of commission. In this scenario, how we can get access to right information to start our investing journey? Very good question. See, that is what I hope you, madam, hope you remember that one of the mantra of simplest I explained to you in the beginning. Invest your time before investing your money. So try to understand, read more. Today with the kind of Google availability, you can just search or you can visit our simplest website also to understand, because you can listen to 100 hours of video of my mentor, Gerard Colosso. I given free of cost there to educate, enlighten, and empower yourself. What I'm telling is that, see, now I can give you some advice, but it's your hard-earned money. So before investing your money, you should be careful. So try to ask all hard questions before investing your money, because once you invest your money, once you return the check, then the money is gone. So invest your time before investing your money. Thank you. Jesslyn madam is asking long-term investment in mutual funds, whether large cap, mid cap, or small cap funds are advisable. Okay, we don't advise mid cap and small cap because of the very high volatility. Because if you look at the return, it looks nice, but it looks nice from the outside. When you invest, then it start biting you. That is a dangerous thing. Then people cannot see the volatility, or if the market crashes, they are not able to hold it. So then they sell and book the losses. So we at Simplest do not recommend mid and small caps. We recommend only large caps. That too, now we recommend only passive index funds, not even active funds for that matter. Because we have seen the kind of things happening in the asset management companies, and the action taken by the regulator, very dangerous. So we completely move out of active fund management. But again, I'm telling you, don't simply jump into any conclusions and invest into large, mid, and small, especially mid and small, because objective, time horizon, your risk profile, and applicable asset allocation, very important. Then coming to I have 3 shares in which I face a loss of nearly 1 lakh. What suggestion you have give to balance my losses in Canara Bank? Okay. See, that's what Soumya madam. So what? See, investment. The moment you say investment, the next word is diversification. Otherwise, you are a speculator or a gambler. 90% of the speculators lose money in the stock market, and the 10% who say they don't are liars. Never get into gambling or speculation or trading because you are trying your luck or you are chasing your luck. Chasing your luck end up with losses. Take it from me. So, diversification across sectors, major Indian economic sectors, industry sectors is important. So, we do not recommend to invest or put money into any few sectors or companies, which is dangerous because it is not a portfolio. See, what is the objective of a quality investor? To earn optimum return. What is optimum return? No risk to capital, and return is 50% to 100% more than the bank FD return. If you are happy with this, you can become a successful investor. But if the bank FD is giving you 7% per annum and you are expecting 20, 30, 40, 50%, no, this is gambling or speculation. And there is a 19% chance of you losing money or 100% chance of losing money. Don't get excessive greed. That is dangerous. That's what I'm telling you. Risk is within yourself. If you expect 30, 40%, somebody will look at you. Okay, you're looking for that kind of return. Come, we'll do trading. They'll make their brokerage. You will never earn. You will lose your capital. So never ever victim of your own excessive greed. Optimum return, not maximum return. So if you ask me those three shares, my simple answer is I do not know, because either they can go up or they can come down. What I can recommend is that if you are already under a loss, book the loss and convert your investment into a quality portfolio so that you can recover the losses and make a optimum return in the long term going forward in future. So holding few sectors, few companies are very, very dangerous. Assuming that our investment is for long term and investment would be 5,000 rupees per month, which SIP would you suggest in long term? So I told you again, investment objective, time horizon, you can mail me. Then we have to get into the process of understanding your goal, time horizon, risk profile. I'll send you my risk profile and applicable allocation. Based on that, I will give you advice. Because this is not a general advice. Please understand. This is the most dangerous thing. A doctor cannot give the general medicine to everybody. Let's say all are suffering from fever. But is it a viral fever or is it a corona or is it a dengue? That's a different thing. So we need to diagnose each person. So we need to understand everybody's financial situation. No general advice. General advice is most dangerous. So if I give a general advice, somebody else will invest and they may be requiring money after 6 months. You're getting my point? So long-term investment is like a planting a mango sapling. But somebody need money after 6 months. They go and go for a mango sapling, and after 6 months they will tell me, Deepak, nothing has come. There is no mango. So time horizon, that is most important. So if you need more clarification or if you need anything, you can get back to me on my email ID and mobile number. Gold investment is good. What about gold ETFs? Gold ETFs is like equity shares. You need to have a demat account. But we at Simplest recommend gold investment to a maximum of 10% of your portfolio. Because you have seen the kind of return it generates for the last 95 years is around 8.63%. So which is not a very great investment even like your real estate and equity. But if you look at the last 1 year return, it has given around already 18%. So what we recommend is the 10% maximum, 10% exposure to gold in the portfolio. For me, important is that portfolio, not how Indian equity, international equity, or gold or debt is doing. For me, average return of the portfolio is important. Yes, that's about gold. Yes, that's correct. If you are okay, now this is very important point. Manoj sir reminded. If somebody gives you investment advice and that is very entertainment and excitement, you are not making any money there. Take it from me. It gives you only entertainment and excitement. So there are so many places where you can go, mall, watch a movie, that will give entertainment and excitement. So don't go for a costly entertainment and excitement by investing your hard-earned savings. That is dangerous. So quality investing is boring. Buy and hold, right? Buy right, hold tight. That's all quality investing. I told you that how many years that 23 years SIP, 1,000 rupees per month, 3,15,000 becoming 54 lakh rupees. Nothing into entertainment and excitement. Every month you are investing money and you are continuing. That's all. So quality investing is like watching paint dry or grass grow. You will never able to realize how every day how much grass is growing, when the paint will get dry. No, it's a process. Can we sell sovereign gold bond in stock market? No, sovereign gold bond you are bought from the government of India, so there is a lock-in period of 7 years. SGB, sovereign gold bond. So that will give you 2.5% interest income also. So government will buy back at the end of the maturity period. Hope they enjoyed the session and learned something about quality investing philosophy.
Definitely, sir. It was good. Yeah, Tracy, madam, go ahead.
Thank you, sir. Thank you very much for this informative session. If there is no more questions to a speaker, I think we can proceed with the vote of thanks. Over to Cassin, sir.
Good evening, everyone. As we have come to the end of 5 days faculty development program, I am grateful to the principal of all the 3 colleges, Reverend Father Michael Santomar, Milagres College, Reverend Father Arun Wilson Lobo, Padua College of Commerce and Management, and Dr. Shivrama P. Government First Grade College, Kavoor. Today, it was an opportunity to hear to Mr. Deepak Rao your thoughts which have enlightened our minds and have shown a new path, a deep and intellectual way of imparting insights and wisdom has added to the glory of this event. Thank you very much, sir.
Thank you. Thanks to all.
Yeah. I would like to acknowledge the contribution of work done by Professor Manoj Lois, General Secretary of Mukta, and also the General Secretary of Federation of Teachers Council of Commerce and Management, Karnataka, in helping me finding the resource persons for this 5 days faculty development program. Thank you very much, sir. Thank you. Yes. I believe in this 5 days faculty development program, we all have achieved great insights which will help us in our life. I would like to express my sincere thanks to all the participants for actively participating in this event. A big thank you to my staff members, also the staff members of Padua College and GFGC, Kavoor. My deep sense of appreciation goes to the technical team, Mr. Denzel DeCosta, Mr. Racing Pinto, and Justin D'Souza. Have a great weekend. Thank you.
Thank you. Thanks to the organizers, principal, faculty members who attended, and Manoj Lois sir for your initiative. Good going. Thank you. All the best. Good day.
Thank you, everyone.
Thank you. Thank you, Deepak, sir.
Thank you. Thank you.
Already the link, that is feedback link, is put up in the chat box. Please fill that feedback link. Thank you, everyone.
I leave, Manoj sir.
Yes, sir. Yes, sir.
Thank you. All the best. Good day.
Thank you.
It will take at least 3 days for your certificates. If only after 3 days, if you don't receive the certificates, please then put a message and see that you have filled all the days links. If you are not filled any of the links, then certificates will not be issued.
Okay, then, Cassin, thank you very much for initiating our Roshan sir from Padua, Zina, then Tracy madam, Denzel, all of them for welcoming, giving vote of thanks, emceeing, everything. So thank you very much. We'll collaborate maybe next time very soon.
Yes, sir.
So thank you all. Thank you very much. Bye.
Good night, sir.